Most people think money is printed when the government needs it. That belief is wrong in a way that actually matters. There's a man, mid 30s, reads the news, considers himself financially aware. He sees a headline about the central bank and assumes someone just turned on a printing press somewhere. He's not stupid. He's just never been shown how the machine actually works. And the gap between what he believes and what's real, that gap costs people real decisions every single day. So here's the tension worth holding. If governments don't just print money into existence, where does it actually come from? And second question, why does more money in the system sometimes cause prices to rise and sometimes barely move? Keep both of those. They'll both get answered, and the answers are more connected than they look. Let's start with the version most people carry around and quietly dismantle it. The common picture is a government running low, calling the mint, and paper money rolling off a machine. That describes maybe 5% of how money actually enters a modern economy. The overwhelming majority of money in circulation today was never printed, it was typed into existence. Plain version, most money is created by banks when they issue loans. Deeper version, when a bank approves a $24,000 car loan, it doesn't move existing money, it creates new money on the spot. The borrower's account shows $24,000 that didn't exist in the system an hour earlier. That number isn't moved from a vault, it's a new liability the bank writes, backed by the borrower's promise to repay. This is called credit creation, and it's the primary engine of money supply in every major economy. A guy walks into a bank in 2019, gets approved for a $340,000 mortgage, signs the paperwork. By close of business, $340,000 of new money exists in the economy that didn't exist that morning. Now here's where it gets structural, and this is the part most financial content skips entirely. Banks don't create money without limits. Two mechanisms constrain them, and both matter. First is the capital requirement. Banks must hold a percentage of their own equity against the loans they write. In general, regulators across most Tier 1 economies require banks to hold somewhere around 8 to 12% in capital reserves. So a bank with $1 billion in capital can, in general, support roughly $8 to $12 billion in loans, not infinite. Second constraint is demand. Banks can only create money when someone creditworthy actually wants to borrow. No borrowers, no new money. The engine stalls. That's a mechanism most people never consider. This is the gear change. Money supply isn't controlled by one lever. It's a negotiation between policy, banks, and borrowing appetite. Now bring in the central bank, because this is where government actually enters the picture. Central banks like the Federal Reserve, the Bank of England, the ECB, don't lend directly to the public. They set the base interest rate, which determines how cheaply commercial banks can borrow from them. When that rate drops to near zero, borrowing becomes cheaper. Loans increase, and new money flows into the economy faster. When the rate rises, say from 0.25% to 5.25% in roughly 18 months, as happened recently, borrowing slows sharply. Fewer loans means less new money created. The engine doesn't stop, but it idles. A man refinancing his business in 2021 locks in 3.1%. His colleague tries the same thing in late 2023, gets quoted 7.4%, decides to wait. That decision, multiplied by millions of people, is literally how the money supply contracts. Now close the second question. Why does more money sometimes spike prices and sometimes barely register? It depends on where the new money goes and how fast it moves through the economy, what economists call velocity. Money created through a mortgage mostly flows into construction, materials, labor, and eventually consumer spending. Money created through a business loan might fund equipment that increases productivity and actually holds prices down. But money that floods into a narrow asset class, say housing in a supply-constrained city, can inflate that specific market fast. In general, when money creation outpaces the actual production of goods and services, prices rise to compensate. That's not a theory, that's a ratio. More money chasing the same number of goods means each unit of money buys less. Now the part about quantitative easing, because this is where the confusion about money printing comes from. When central banks do QE, they buy financial assets, mostly government bonds, from commercial banks. They pay for those bonds by crediting the bank's reserve accounts with new money. That part is real money creation. But here's what most headlines miss. Those reserves sit at the central bank, not in the general economy. They only become circulating money if banks use those reserves to back more lending. If banks don't lend, because borrowers aren't there or creditworthy, QE can be enormous and inflation can stay low. That's roughly what happened between 2009 and 2015 in the US. Trillions created, inflation stayed near 2%, reserves stayed parked. So the printing press image isn't just simplified, it's pointing at the wrong mechanism entirely. Now here's the smart objection worth addressing directly. Okay, but if banks create money through loans, what stops them from just creating unlimited money forever? Three things: capital limits, default risk, and the fact that loans must eventually be repaid. When a loan is repaid, that money is effectively destroyed. It exits the system the same way it entered. Money created through a $24,000 loan disappears when the last payment clears. The cycle completes. This means the total money supply is constantly being created and destroyed simultaneously in millions of transactions every day. It's less like a reservoir filling up and more like a river, always flowing, always draining, level set by the rate of both. Here's the model in plain language before we close. Governments and central banks set the conditions. Commercial banks create most of the actual money through lending. More borrowing means more money in circulation. Less borrowing or more repayments means less. Prices respond to the ratio of that money against the real goods and services it's chasing. Ask yourself this: when you took out a loan or decided not to, did you realize you were participating in money creation? Most people haven't framed it that way, but that framing changes how you read every interest rate headline from now on. This week, look up your country's current central bank base rate and compare it to where it was 3 years ago. The gap between those two numbers explains more about your cost of living than most political coverage ever will. If that kind of structural clarity is useful to you, the next video goes one layer deeper: why inflation hits some people 5 times harder than others even when the headline number looks the same. Money is not a thing that exists, it's a promise that circulates, and banks are the ones making most of the promises.